Welcome to Talk Tickers, where we dive into the earnings calls that are moving the markets. Today, we're looking at People's Bancorp. Now, they just dropped their Q4 numbers, and it was a bit of a mixed bag, but the stock actually ticked up. So what's the story here? Let's get into it.
All right, let's jump right in. The headline number here, the one everyone looks at first, is that bottom line. And it was solid. PBO delivered an adjusted EPS beat of 4 cents. A clean beat on profitability, that's always a great way to kick things off.
But here's where it gets interesting. While the earnings were a beat, the overall headline was actually mixed. You see, that strong EPS was sitting right next to a slight miss on revenue. It came in just a little shy of what Wall Street was expecting. And yet, despite that top-line miss, the stock still closed up 1.15% on the day.
So that's the big question, right? Why did the stock go up on a mixed report? What did the market see that made them basically ignore that revenue miss? Well, the answer, in a word, is execution. And that brings us to their game plan. This wasn't about chasing some huge, flashy growth number. No. This was all about management's really sharp focus on controlling the controllables. And you know what? They did it really, really well. Let's break down how. So you can see some of the key drivers right here. They showed some serious cost discipline. For instance, they paid off some high-cost debt that was yielding around 8.5%. Just that one move is going to save them about $1 million a year. Pretty smart. Plus, they grew their net interest income 5% year over year and kept their efficiency ratio nice and stable. And this quote from the CEO, Tyler Wilcox, really says it all. We would rather deliver lower loan growth than unfavorable metrics. I mean, that's crystal clear, right? They are not chasing growth for growth's sake. They're putting credit quality first. And in this kind of environment, that's exactly the message investors want to hear. Okay, so all of this disciplined execution, it leads us directly to what is, for me, the most important part of any earnings call, the guidance. This is where management tells us what they see coming down the pike for 2026. And what they laid out is really a picture of stability. We're looking at a pretty strong net interest margin between 4 and 4.2%. Loan growth is expected to be in that 3 to 5% range, nice and steady. And crucially, they gave us these quarterly numbers for fee income and expenses. Having those clear guardrails really helps take a lot of the guesswork out of the equation for investors. Now, there is a really important assumption baked into all of this guidance. You have to know this. Their entire forecast is built on the idea that we'll only get one single 25 basis point rate cut from the Fed in 2026. And what I really liked is that they didn't just leave it at that. They actually gave us the sensitivity. They said, look, for every additional cut the Fed makes, you can expect a 3 to 4 basis point hit to our net interest margin. That kind of transparency is huge because it lets the market model out different scenarios. All right, so moving beyond the hard numbers, the Q&A part of the call brought up something really interesting, a key strategic point about the bank's future. And it all centers around one very, very important number in the world of banking. And that number is $10 billion in assets. You might be wondering, why is that such a big deal? Well, for banks, crossing that $10 billion line is a massive regulatory event. It triggers a whole new level of scrutiny and, you guessed it, a lot more compliance costs. So when asked about it, management was incredibly direct. They said flat out, we are not going to cross that line organically. They actually have levers they can pull on the balance sheet to make sure they stay just under that threshold. No ambiguity there. So if they're not going to do it organically, how would they ever cross that line? Well, the CEO gave us the answer right here. We continue to be interested on the acquisition side. And that's it. That's the key. The only way they're going over $10 billion is through M&A. And that makes an acquisition the single biggest catalyst that could really change the story for this bank. Okay, so let's put all the pieces together. You've got the solid Q4 results, the very clear guidance for the year ahead, and this M&A optionality. So what does it all mean? Well, here's our prediction. This is the next call. And we've broken our verdicts down into 3 simple parts. First, what do we expect from next quarter's results? Second, what do we think the stock's going to do? And third, what's our official rating on PBO? So here's what we think. For Q1, expect an inline quarter, pretty much consistent with the guidance they just gave. The market is going to be laser-focused on that net interest margin and how it holds up. As for the stock price, we see it trading in a range for now, probably just moving with the rest of the regional bank sector. A big move up or down is going to be tied to one thing, concrete news about M&A. Which brings us to our rating. We're initiating on People's Bancorp with a market perform. Look,
The bottom line is they are executing really well, and they have a super clear plan. But they're also facing the same interest rate headwinds as the rest of the sector, and the valuation seems pretty fair compared to their peers. So for now, we think a neutral stance makes the most sense.
And just as a final note, please remember this analysis is for informational purposes only. It is not financial advice.